Well, good afternoon. Good afternoon and welcome to another Webinar Wednesday, hosted by the California State University's Bakersfield Small Business Development Center. This is webinar number 300 of our webinars that we produced live, locally, and mostly weekly, going back all the way back about 10 years. So webinar number 300, got a great webinar for you today. You know, we're talking about one of my favorite subjects, and that's cash flow for business purposes. I'm your host, Kelly Bearden. Thank you for joining us, and let's get going. So what is up today? Today, November 29th, 2023. I trust that you had a fantastic, a terrific Thanksgiving, and now we're getting back into it. I know one thing in life, that you have cash flow if you have a business, or you better have cash flow, and might as well be positive. And so that is going to be the focus of today's program. And we're going to get into what you can do to generate a positive cash flow. We'll talk a little bit about, before we bring Mike out here, we'll talk a little bit about in 2024, the Corporate Transparency Act. And the Corporate Transparency Act is this legislation that is going to become effective on January 1, that can really alter the way that you operate an LLC or an incorporated business in the United States. So big changes and big penalties for those that don't comply with those changes. We'll be talking about this tons in December, but just give you another heads up today about that. Our regular feature here on Webinar Wednesday is our Capital Quarter, where we talk about ways of accessing capital for your small business. And today we're going to celebrate how crucial cash flow is in that decision for you to get funded, or you get small business loans or other types of funding for that particular matter. Our resident economist, our Webinar Wednesday resident economist, Dr. Evans, will return. He'll return soon in a couple of weeks. Until then, you know, I think we should all just celebrate the economy and know that our Economic Corner segment is going to celebrate the end of rate hikes. Yes, the end of rate hikes. Apparently, with the October level of the Consumer Price Index, the rate of inflation reducing down in October of 23, has kind of signaled to the Federal Reserve to put a pause or hit the brakes on rate hikes. So those of you that have variable rate financing, that has rose substantially. Those that have put together programs that you might have wanted to do, access capital for an expansion or growth, have put those on pause. So maybe with the end of rate hikes, we can actually see some reduction in rates and see where the economy is going. But we'll let Dr. Evans tell us about that when he returns. We will talk about some of the other reasons why we think it's important and actually critical to have data for accessing capital in our communities. Sadly, a businessman's life, well-lived returns. A segment we've done before where we celebrate the life of a successful businessman. Maybe it's somebody we know, maybe it's somebody we don't. Leave a lasting impact on the communities that they are part of, and we will have a tribute later today on that. We'll have some quick updates, resources, business tools. As always, we'll take your questions answered live on today's webinar at the conclusion of our presentation today. So if you have questions, you're going to want to go to the Q&A box. Our Webinar Wednesday producer, Maureen Busherdang, will be manning the actual chat box, and she will be putting resources for you availability to take and actually use those resources on demand. And also, so those resources will be in your chat box. And let's go on to our poll for today. We do have a 2-question poll, and our first poll question is going to be kind of tied to today's topics. And what we're wanting to know is how you actually find out about your current cash flow. So I find out about my current cash flow from my bank statements, my financial statements, my accounting software, or my credit cards. And yes, I could have added other and had you go, but I figured this would give us a good enough understanding of where right now you're finding out from, say, a month-to-month basis on what is happening with your cash situation. So do you presently use your bank statements? Do you go to your maybe your checking or your savings or other type of bank account that you have? Do you actually go to your financial statements, your monthly, quarterly, or even maybe prepared differently, either internal or external financial statements, your accounting software? Do you access that? Or do you look at your credit card balances and say, oh, my balance went up, my cash flow must be negative? So we do have 66% of you participating at this point. Just click to 70. Thank you so much. We're going to end this first poll and in the first poll and share the results with you. And oh, that is great. Look, 35% of you are getting it from your accounting software, another 35% from your financial statements. So those are the main two, getting it from your on-demand or actually created demand and data for your financial statements. Bank statements was third at 25%, and 5% of you get it from those credit card statements. Okay, so we'll stop that particular poll at this time and actually now go on to a little more whimsical type question, because I know you like those there, because it's a little bit about our subject topic for today. But let's now move on to the particular part, and it's a little bit more whimsical. And this is going to be focused on basically the pandemic and country, what country had the best performing economy during the pandemic, but has now declined significantly over the last year? It is a European country. Was it Greece, Spain, or Ireland? So we're looking at three countries here in Europe. And one of them had the best performing economy, or one of the best performing economies during the pandemic, did very well because of ties with US technology and biotech, and maybe some other reasons involved there. But over the last year, they have fallen on harder times. So good during the pandemic, better times, not so good. Okay, great. 73% of you in. Love the participation today, the participation rates. And now that we have 76% of you that have participated, we're going to go ahead and end the poll. So we'll end the poll and share the results, and 55% of you are correct. It is Ireland. Ireland, 55%. Greece was your second guess, and Spain bringing up the rear. So thank you for participating in our particular polls today. And let's move along. So moving right along is the Corporate Transparency Act. And yes, that is effective on January 1, 2024. If your business is incorporated, or if you are a limited liability company, this new law will affect you. And what it will do is it'll enable, it was enacted to actually collect information on owners of corporations. And it was done to curb illegal activity such as money laundering, fraud, trafficking, financing terrorism, could have something to do with some of the sanctions on some of the wars, Ukraine, and so forth. So the Corporate Transparency Act is to find out and get that information from business owners, and it is statements that you very well may need to file. So the broad reach of this will affect companies and individuals where it really wasn't intended to. It can be your very small business that is maybe a single member LLC. So, and that goes far beyond the illegal activities, but you may be required to register your personal information in a federal database, and that will be due on January 1 of 2024. Like I said, we're going to be talking a lot about this in December and get into some more of the specifics and more of the actual filing with that. So stay tuned, as we like to say. So our monthly capital quarter, our capital quarter, weekly capital quarter, is our segment on accessing capital. We had a lot of fun when we had the debt ceiling, when Congress, had the debt ceiling crisis a number of months back. And we looked at, how could there be a debt ceiling for small business? So we looked at a variety of different factors, and also today's topic of cash flow plays right into it. So, it has been a long requirement of lenders, particularly banks and those doing SBA type financing, more traditional type of small business lending, that historic cash flow was essential to getting actually small business funding. More programs now are coming along where they're allowing projected cash flow, which should tie right into our topic today. So being able to project your cash flow so your lender can, first of all, believe the assumptions that you use to get there, and then also actually use that as a projected cash flow to actually project how your business is going to perform financially in the future. You're going to get a loan for 5 or 7 years. A lender's going to want to know those 5 years at least about how you're going to be able to project that you're going to pay cash flow if you don't have historic cash flow. And historic cash flow traditionally comes from bank statements, but really wants to see is your tax returns, because you've validated those with the U.S. government. So tax returns has long been used for historic cash flow, and now a projected basis of where you can say, based on this is going to happen, and these are believable assumptions in my business. So also lenders must be able to see that cash flow is evident so they can actually pay off the loan. And, we've had people come to us before and say, well, my business isn't going to generate enough cash flow to pay off the loan, at least for a while, but we do have reserves and we have other things. Or we might have income that we're receiving from, say, rental property. But a lender's not going to want to see that. They're going to want to see that it comes from the business operations. They're going to want to see that what they're funding is actually the reason why that is going to pay for itself over time. So it's imperative that you know your numbers, such as the cash flow coverage ratio that we've covered in the past, the cash flow coverage ratio, or any of the other 5 financial ratios that will affect your cash flow. And cash flow might probably touch on some of this today. So there's how our cash flow kind of comes into our capital quarter of accessing capital. As you probably know, if you've been on Webinar Wednesday for over the last couple of months, we are working with the Federal Reserve Bank locally out of San Francisco, and the Federal Reserve Bank nationally does a small business credit survey. And it's a fantastic survey because what it does is it looks at small business owners and looks at some of the problems that they're having accessing capital, some of the good points in accessing capital, and they do this all in a 12-minute survey with thousands of business owners across the country. So in our partnership with the Federal Reserve Bank of San Francisco, what we're doing is we are providing a link that is in the chat, I'm sure. And the link to the Federal Reserve survey will ensure us that we get actually financial information on Kern County and Central California region. So what this is doing is if we have enough respondents, which we've already met, thank you very much, we will be getting this critical data which will help us guideline our programs in the future and also look at some of the issues and problems in accessing capital for small businesses and some of the programs that are actually making it easier for those to do so. So some of the data that has been provided in the past, for example, this is California data. You'll see that last year the survey did 3,000 firms nationwide. 279 of those were in California. We're going to have at least 100 in our Central California region. Thank you very much again. So this one is basically just the outcome. What is the outcome of a loan, a line of credit, a cash advance? What happens with those applications? And we see that in California, there is a higher rate of those being denied or being only partially approved rather than those being fully approved. So why would this information be valuable on a local level? Because it would really show some of the issues again and some of the opportunities that we have in order to get better access to capital for our small businesses. So thank you for doing that. Some of the other programs that are available for those of you in Mono County, Mono County has a program with $10,000 business grants. I'm sure this is ARPA money that came to Mono County through the federal government. And you can apply for a $10,000 grant before December 20th. And you need to register your small business at the Small Business Digital Ready. You'll get more information there on actually finding out about that particular. You want to run a childcare business? There's a childcare business that you can go through Nurture, our free resource hotline. It will be in the chat also. But I really want to spend a few minutes and just talk about a local businessman's life well lived. And we're talking about Jim Arnold. And Jim owned a very successful business services firm in Orange County before retiring to Tehachapi, where he acquired Triassic Vineyards, produced some great wines in the Tehachapi Valley. The Tehachapi Mountain American Viticultural Area was the first specific, so they actually have an AVA and actually market their wines under Tehachapi Mountains. Along with his wife, Sally, they were recipient of a 2018 Kern County Small Business Award for agricultural business, a great community civic leader, supporters of nonprofits in the community, and actually was a presenter on Webinar Wednesday, number 151, which was 37 of the 138 live pandemic webinars we did every Wednesday live. And he actually came on the day before Thanksgiving back in 2020, and we talked about some of the great things going on and great places to go in Tehachapi. If he was here right now, I'm sure he would tell me to invite everybody to still take trips to Tehachapi to enjoy the fine wines, food, people. And as an SBDC client, we produced a little video that I want to share with you on Jim and Sally Arnold and the Triassic wine story. So take it away.
We were in a situation where we had sold our business and our children had raised and moved out of the area, and we were trying to figure out what the next step was in our life. And Sally and I stopped in and had some wine and thought it was interesting, but really didn't mean anything other than just another wine tasting room. But I thought it was kind of neat that that was happening in Tehachapi. That was back in 2008, 2009. Little did I know, fast forwarding it, that we'd buy the place. The original owner of the vineyard was a geologist, and to make a long story short, he discovered that this soil was Triassic soil. And what's unique about it is that goes back 220 million years when the dinosaurs were roaming the earth in jungles. But most Triassic soil is about 4,000 feet below the surface of the earth as the earth has evolved. But as a result of an earthquake, we don't know how many millions of years ago it was, the two hills behind our vineyard came to the surface with Triassic soil, and it creates really good drainage for the root system. The moisture goes deep, that allows the roots to go deep. It's able to draw more nutrients from the soil to really make good wine from the grapes. One of the things that I found interesting once we moved up here was the fact that we were not a wine growing region, and I looked into what that meant to the community as far as growth and value to the community. And as I got more involved with the community, I saw a real opportunity to make a difference here. We've got a wine growers commission, and we are working together to learn from each other. Right now we have 7 vineyards. We have 2 wine tasting rooms that are currently open and 2 more under construction. And we're in the process of the paperwork to go through the Treasury Department and be recognized as an AVA, which is the American Viticultural Area, where we'll be recognized as a wine growing region. And that really means a lot to the community because it will help bring revenue to Tehachapi and to Kern County, but also it'll keep revenue from leaving Kern County, where people go to places like Paso Robles or Santa Barbara or Temecula to have a nice experience with wine tasting. They'll come to Tehachapi. One of the things I learned in my career is that it's impossible to know everything, but I've learned that you don't have to know it all, you have to just know the people that know it. One of the individuals that I met is Jay Thompson, who was part of SBDC, and Jay has been very helpful for me when it comes to understanding business here in Kern County and Tehachapi, and resources are available for capital, grants that is going to be very helpful for our business. You know, all of our success depends on helping each other. And I think that's one of the things I've learned about this rural community up here is people want to help you succeed. And they do. I mean, our vineyard was planted by volunteers. And I think that was one of the things that appealed to me. Said a lot about the community that I felt we wanted to be a part of that, because it's been really a pleasant surprise coming up here and finding the people that help each other and are looking to help you succeed. And certainly the resources that are available here through SBDC is part of that makes you feel like you're not alone.
Well, Jim, you will be missed. Love the Tempranillo. Tempranillo, great wine. And again, he will be missed. So a couple of things real quick. Our community calendar. Let's skip that a little bit and maybe just jump back over to some of the tools that we have for you. And there's that tool is that cash flow forecasting, and you're going to find a lot more cash flow tools in just a couple of moments. So live planning, and also some of the tools that we actually have in resources. Our YouTube channel, you'll be able to find this webinar on our YouTube channel shortly afterwards, and you'll find over 250 of our webinars on that particular channel. Love your feedback. If you have feedback from today's webinar, please complete our survey. Go to our YouTube channel, subscribe, or leave a nice message on our business profile on Google. So coming up next week is we're going to actually shift bases and go and talk about nonprofits. We don't do a lot in the nonprofit area, but there's some great resources that are out there. We're going to have Eric Ryan, who's going to be here along with Aaron Falk of the Kern Community Foundation, talking about some great nonprofit strategies for nonprofits and a number of other programs coming up. And that brings us to today's special guest, Mike Milan, aka Cashflow Mike. He offers strategic planning in finance and sales, more than 20 years of diverse professional experience. Mike's developed 14 startups into well-established businesses, earning the nickname Cashflow Mike. An Army veteran, thank you for your service, with an MBA from Baylor University. Authored a couple of books. I'm really kind of interested to find out about Don't Be a Dumb Business Owner. That's got to be a great acronym, I would assume. He's created also Clear Path to Cash, maximizing your cash in any business situation, along with FinTech software products. He is a business finance specialist behind Cashflow Mike. He's helped so many businesses. He's co-host of a podcast, Mike and Blaine, where the focus is on topics and lessons you can learn by being an entrepreneur. Mike, Cashflow Mike, it's great to have you here today.
Man, live from San Antonio, Kelly. Can you believe it?
I can believe it. I can believe it. How is the weather in San Antonio today?
Yeah. All right. So you guys, I guess you can sympathize with me here, empathize, because it was in the 50s and I was cold, right? And I was absolutely cold. So anytime it dips below that 70 level, I mean, I tend to get cold here in Central Texas. I live right in the hill country. Lots of great vineyards. So what a great piece. And I got to tell you something, Kelly, I'm on a lot of webinars, and you are as polished of host as I've ever seen, my man. You are just fantastic.
And we're going to have you back.
Yeah, it's fun. So
thanks, Mike.
I got good stuff. Yeah, got good stuff for you today. Okay, I guess it's my turn.
All you.
All right. So, hey, it's Cashflow Mike, right? It's a funny nickname, but it was given to me by some bankers a while back, mainly because I stopped talking about profit. And probably what's not talked about at all, in my background was the fact that I built 14 businesses. I built a hotel staffing company, is the largest one I built. And I opened 27 offices in 9 states in 3 years, right? So if you want to talk about somebody that learns cash flow fast, try keeping up with 27 offices, 500 employees, when you're dealing with Marriotts and Hiltons and Hyatts that tend to pay in 90 or 100 days when I've got payroll to make every 2 weeks. So I learned a lot about cash flow and balancing cash. If you've ever said this to yourself, I'm making money on paper, why don't I have any? Today's for you, because what I do is we talk about how much money you have versus how much money you need. That's the hidden part. That's the part that nobody really ever tells you about, is how much you need. I'm going to teach you how to calculate it today. Kelly, because you asked, I did author a book called Don't Be a Dumb Business Owner, and dumb doesn't mean unintelligent. It means I don't understand my business. and how to come up with it? Well, I was sitting there at the kitchen table. I'm like going, what am I, dumb? How come I can't do this? I feel like I don't understand my business. And then boom, it kind of hit me. That's what it should be. Additionally, a little bit about me again. I'm going to give you some resources. Like I've got a free web worksheet, spreadsheet that goes with this. If you want it, put your email in the chat. I'll grab it out, or I'll send it out to Kelly and team Marine. But yeah, that's what I do. I've trained probably 25,000 different bankers, accountants, and business owners at this point in time. I think Kelly and I connected through the SBDC, where I was a presenter at the national conference in Nashville this year. So I'm really, my heart is in the SBDC, and I want to help any way I can. So to get started today, I do have a free ebook. I've got this ebook on my website. If you go to cashflowmike.com, it's called the 7-Minute Conversation. It's how to analyze any business in 7 minutes or less. There's 6 calculations, and I call it the home run financial system. You might be saying, well, why do you call it that? Well, because it touches all the bases. It uses the income statement, the balance sheet, and the cash flow statement. 6 calculations any of us can do. Just go to my website, download it for free. If you have questions of me, there's my email address, mike@cashflowmike.com. So that actually should help. Mike@cashflowmike.com. You can always send me a thing. And then I have a free Facebook group where I'm continually giving out resources. So if you need pricing calculators, if you need a forecasting by the numbers, how to do forecasts at the end of the year, including the balance sheet, join the Facebook group. All that stuff's in there for free. You can download it and use it. So it's just the clear path to cash on Facebook if you're inclined to be social media savvy. All right, so today we're going over fast money formula. Now, everybody probably on this call knows how money moves through the company, right? You start with sales, it kind of moves all the way down through, you subtract everything out to net profit. That's money moving through. That's the vertical movement of money through your company. But the problem is that our financial gap gets out of whack because there's a horizontal movement of money as well. And this is what I call fast money. What I mean by horizontal money, it's I recorded it on the income statement, but I didn't get the cash yet. If you've ever felt like this, and this is the reason why I brought it up, was I felt like I had money. I felt like I should have money, but I couldn't pay a bill. It felt clunky. It was like I was always waiting for someone to pay an invoice before I could do something next. So if you've ever felt like it's just clunky, it's not running smooth, it's because your financial gap is out of whack. So today we're going to cover the 4 things pretty basically about what are the levers that actually drive cash flow in not only a business with inventory, but I'm going to show you a different version with a service company as well. We're going to look at, the financial gap. If you don't know that term, it's the time when your company doesn't have enough money, right? It's the difference between money coming in and money going out. So it's called the financial gap, and I'm going to explain exactly what that is and show you what it looks like. Then we're going to analyze and see, how to identify if you have a cash shortage and how much. One of the slides I liked earlier was, how many people get denied for lines of credit, those type of things. I'm going to teach you how to know how much to ask for, how to calculate it, and how to tell the story to your banker so that they feel comfortable in lending money to you, right, in a line of credit. And then understanding the difference in cash conversion cycles between inventory companies and service companies. We get that a lot as well. I tend to talk fast. He gave me like 20, 30 minutes. So if I'm too fast, don't worry. Shoot me an email. I can go back. Anybody that's on this call, anything for the SBDC, I can kind of help catch you up. All right. Oops. So let's talk about, first of all, how much money you have. Anybody on the call, can you put in the chat? Anybody on the call know what the calculation is for how much money you have? Anybody know? So it might not be something that, well known. But if you've ever heard the term, and I don't know if anybody's put it in, I haven't seen anybody put it in yet, but if you've ever heard the term working capital is how much money you have, right? And it's a basic, simple calculation called, our current assets minus current liabilities. Now, if you've heard a current ratio, that's current assets divided by current liabilities. So they're kind of 2 peas in a pod. One talks about how many dollars you have. The other is how much in relationship to how much you owe. The ratio is the current ratio. The dollars is the working capital. So when I talk about, to just regular small business owners that don't understand what a current asset is or a current liability is, I always give them an example. Current asset, your checking account. Current liability is a credit card. So if you see that you have any money at all, it says, how much money do you have to pay for the credit card out of your checking account? That's basically what we're looking for. So because I don't want to go back and teach to a financial statement, I've got some sample numbers. I just threw it in here so you can do the math along, but I'm not going to go make you look for the numbers and say, tell me what the current assets are, tell me what the current liabilities are. Just know that on the sample sheets that I usually give out in my course, current assets are 2438 and current liabilities are 1808. So this company has a working capital of 630,000. So is that good, fair, or terrible? What do you think? Good, bad? Maybe throw it in chat. If you think it's good, give me a thumbs up. If you think it's bad, give me a thumbs down, whatever you like. Just go ahead and throw that in the chat when you can. All right. So they have $630,000, but here's the problem with it, right? It seems like it's a lot. It seems like you should have enough. But what most people don't know is, I don't really know because I don't know how much I need. So most calculations stop here, which is how much you have. The second step is how much do I need? And Mary's going good, bad, bad, good. So in an inventory-based company, let's talk about how to calculate how much you need. There's basically 3 levers. Now, to explain this to folks, I always try to put you back into your store, right? So imagine you're a retail shop or you're somewhere where you have inventory and you sell on credit. So what you do is you call up a vendor. You say, I need 100 units of X, Y, or Z. They deliver it and they give you an invoice, and you take that invoice and you put it on your desk. And then a certain amount of time later, maybe a month later, you pay the invoice. That's one part. That's the money out. The inventory comes and sits on your shelf for a certain number of days, and finally someone buys it. And when they buy it, you give them an invoice, and then that invoice sits on their desk for a certain number of days. That's the money coming in. You're waiting. The inventory is sat on the shelf. The invoice is sat on somebody's desk and they finally pay. That's the amount of time it takes for money to come in. The amount of time for you to pay your own invoice from the vendor is money going out. So the calculation is pretty simple. It's the difference between the two. You're going to take and convert this to days. Now, one of the things I don't think is in my bio, maybe it was, is that my first job out of college, I was a state trooper. So I used to measure speed in miles per hour. In business, we measure it in days. That's how fast things move. And we want money to move fast. Cars to move slow, money to move fast. That's kind of the difference now. So we're going to convert it to days. How many days does inventory sit on the shelf? How long does it take for somebody to pay an invoice? And how long does it take you to pay an invoice? You take inventory and you add AR and you subtract AP, and that equals this concept that we call the financial gap, right? Financial gap is theoretically the amount of time that your company doesn't have enough money to run, and you either need to put more money into the company or keep more money into the company, or you need to ask for a line of credit to cover this gap. So that's the first part of it, is determining how large of gap that you have. And you're like, oh, Mike, I don't get it. It's inventory plus AR minus AP. Can you show me a different way? Well, let me put it on the calendar, because most people will look at these things in silos, like inventory is one thing, AR something else, AP something else. I want you to look at them as they're happening simultaneously, that they happen at the same time, that they're concurrent. So we're going to take that same concept, inventory plus AR minus AP, and calculate the financial gap. So in this example, we're going to say we have 15 days of inventory. That means when inventory is brought to my place of business, I put it on the shelf and it sits there for 15 days, right? This is just a calendar kind of showing you how things line up. Then I sell it. And when I sell it, I give an invoice to my customer, and that invoice sits on their desk for 27 days, right? So now this is how long I'm waiting for money to come in. I have the inventory. It took 15 days to sell it. Then I waited another 27 days to get paid. At the same time, I'm paying my bills. I've got checks that I'm writing. So I'm going to subtract the time that it takes me to pay my bills, that AP days, accounts payable days. So I'm going to subtract accounts payable, and watch this. I'm going to overlay it right on top of it, right? There it is. You see how that kind of overlays on top? There's inventory plus AR minus AP. If you notice, these bottom 2 rows don't change. That time there That 12 days is called the financial gap. I need enough money in working capital to cover the financial gap. If your business feels clunky, it's because your working capital isn't sufficient to cover this amount of days. Your gap's gotten too large. So what does that mean? How do I put that to use in my real life? Well, in a sample company I use in the course, we've calculated up their inventory days, their AR days, and their AP days. Their inventory days is 90, and the industry average is 60. Their AR days is 34, and the industry average is 44. Their accounts payable days is 56, and the industry average is 34. So it's 90, 34, 56 are the three numbers we're going to talk about. We've got 90 days worth of inventory. We're going to add in 34 days of AR. 90 plus 34 equals 124, right? 124 minus 56. So it's inventory plus AR minus AP equals 68 days. The gap is 68 days. And you go, yay, I got 68. Well, 68 again doesn't mean anything to you, except for the fact that you have to have enough money to cover 68 days. And you're like going, okay, Mike, how do I calculate that? How do I know, how much I need to cover 68 days? Well, in an inventory-based company, you still have to have inventory to keep selling, to keep this thing ongoing. So we're going to use your cost of goods sold number. You got to remember, when you buy inventory, it sits on your balance sheet as an asset until somebody buys it, and then it gets moved out of inventory onto the income statement in the form of cost of goods sold. So we're going to connect inventory to cost of goods sold for this number. And here's how I do it. Here's how we calculate how much you need in a inventory-based company. We're going to take our cost of goods sold and we're going to convert it to a daily amount of spending. So I divide my cost of goods sold for the year. We'll say 58, 55, divide that by 365. How much do I spend per day on average? And that tells me I've got $16,000 per day, because this is 5.8 million in the scenario. So 5.8 million divided by 365 equals $16,000 a day. I have to spend that in order to keep up with my sales value. So once that happens, I then multiply it by 68 days. 68 days, 16 times 68. Now we have a cash need of $1 million. So was 630,000 enough, right? Because we're looking if we have a shortage. We have 630,000 in our working capital, but then we need $1 million. So this company's short $460,000. Whoa, it makes a big difference. Normally, when I go in and talk to bankers, they'll tell me people come in and ask for loans like this or lines of credit like this. They'll say, all right, Mr. Banker, I need a line of credit. And the banker will ask, okay, how much do you need? And the guy will go, I don't know, how much will you give me? Right? If you're answering questions to the banker that way, you're starting off on the wrong foot, right? Because one of the 5 C's of credit is character, and it's about you. Can you run the business? Do you know your numbers? Are you kind of one of those business owners that are savvy financially? How different would it be if you didn't say, how much will you give me? Instead, you say, hey, listen, here's what's happening in my business. I've got 90 days worth of inventory. I've got 34 days in AR. I'm waiting 34 days to get paid. I'm paying my bills in 56 days. That gives me a gap of around 68 days. And I'm like going, well, how do I know the banker knows that? I know it because I taught at the Graduate School of Banking at LSU, Colorado, and the University of Washington for 4 years. I did small business banking, and this is the exact formula that I taught bankers how to do to calculate a line of credit. I thought it was only fair to also tell the business owners how to do this as well. So you have a cash shortage, and you're telling them the whole calculation that we just did. Because I'm spending $16,000 a day, I've got a gap of 68 days. I need $1 million, which means I'm short $460,000. There's a shortage. Now, before you go to the bank, remember I called these levers. Just 2 slides ago, I said you've got 3 levers you can pull. You've got the inventory lever, you got the AR lever, you got the AP lever, which means I always suggest keep those at the industry average. So when you get into a short-term cash flow crunch, I can reduce my inventory, get more cash. I can make some collection calls, and then loosen up to get more cash. I can send out an invoice a week or 2 longer to keep cash in the company. Well, we have levers here too, right? Remember his industry average, he had 30 more days of inventory than anyone else. He was already collecting faster and he was already paying slower. So because these are double-edged swords, you might hurt your relationship with the vendor if you keep paying too slow, or you might hurt your relationship with your customers by being too aggressive with your sales or your collections. The only real lever we've got to pull before we go to the bank is the inventory lever. So let's run that down to just what the industry average is. Instead of 90 days, let's run it down to 60 days. And you might be asking, well, how does that put more money in my pocket? One way is you're going to sell, right? So you get more cash in. But what do we normally do when we sell inventory? Yeah, we go buy more. So instead of buying more, we're going to keep it at a lower level, which means I don't have cash leaving the company. I keep it in my pocket. If you don't know how much that you need of each particular item, SKUs, ask me for my inventory master worksheet, which tells you how much you should have on a regular basis, how much you should order. So if you have 8 and you need 10, you should only order 2. I've got a worksheet, spreadsheet. I'll give it to you for free. Just ask for it and I'll send it out. So inventory master worksheet. And the other one I have is the fast money formula for this calculation. Okay, so now if we don't have 90 days, we run it down to 60 days worth of inventory. 60 plus 34 is 94 minus 56. We didn't change these at all. We only changed one number. That means our financial gap is 38 days. Just like a gap in your real life, the larger it is, the harder it is to jump over. Well, the smaller it is, the easier it is to run your company in this case. So the smaller the gap, the easier it is to run the company. So if we do that, everything else stays the same. I still need $16,000 a day, but I only have to cover 38 days, not 68. In that case, I only need 609. So if I have 630 and I need 609, I'm good. There's no shortage. We don't need a loan. We just need to manage the gap. So before you ask for a loan or a line of credit, make sure you're looking at these levers. Are there things you can do in your business to balance it out to where you'll have cash or keep cash in the company and it won't feel clunky and it works you out of a lot of cash flow situations? So you did it. Now, service companies are a little different, right? Service companies are different in the fact that they don't have inventory. But because I ran a service company with a lot of employees, I had an inventory of hours, people's time, right? Because I would collect timesheets and turn those into invoices for the hotel. So people's time was my method of commodity, right? It's my cost of sales or services sold instead of goods sold. Well, here's what you do different. Because it's time, I have a payroll amount attached to it. So I'm not going to look at inventory. I'm going to ignore it. Inventory is 0. It's going to be about the same calculation though. The next thing I'm going to do is I'm going to add in AR days because I gave an invoice to my customers, the hotels, Marriott, Hilton, Hyatt, and they would pay, we'll say, in 25 days. What am I doing in those 25 days? Well, I'm paying my employees, right? And if I'm paying every 2 weeks, I'm going to divide it by the amount of time in 2 weeks. If I pay every week, it's 7 days. If it's every 2 weeks, it's 14 days. If it's every month, it's about 30 days. So I'm going to take my AR and divide it by the amount of times when I have to make payroll. And this will tell me how many payrolls I have to cover in that cycle. In this case, it's 1.78. Now, you and I don't talk on 1.78. We would just say 2, right? Because I would have payroll number 1 and then payroll number 2. So I have to have enough money to cover 2 payrolls because I'll make the payment to the employees and then the customer should be paying me. That's how you determine how much money you should need in a service company, is based on how much payroll you're spending on a regular basis. So in this case, our sample company had $326,000 that went out every 2 weeks, right? That was to all their employees. They paid $326,000. We're going to multiply that by 1.78 or 2. You can just put it by 2 or just be a little bit larger number. So 376 times 2 be 580,000. Well, same thing. We're going to compare it to how much we have. I need 580. I have 630. I'm good. I don't have a shortage if I'm a service company. I have a shortage because I'm an inventory company, right? So all of that's good. That's the difference between an inventory company and a service company, is we're going to use payroll versus our inventory or cost of goods sold. That's kind of the big difference. So we covered that. Let me show you the spreadsheet that I have. And then if you like apps better, I do have an app. I'll just show you what it looks like on the app. So let me show you the spreadsheet that you're going to get. And then I'll turn it back to you, Kelly. I think that was about the time you gave me. All right. The spreadsheet that I have for you, the Fast Money worksheet, is just this, right? You're going to enter in these gray. It's just 1, 2, 3, 4, 5, 6, 7, 8, 8 numbers. And I do all the other calculations for you. But really what it's telling you is, and it's conditionally formatted, it will actually go red if you have a shortage and tell you how much you're short. If you want to play what if scenarios, you just click it in here. Watch what happens. If I type from 90, we reduce inventory down to 60, then you don't have a shortage anymore. So this is already built into it, and you can play with your what if days right here. Or if you're more apt, I do have an app. It's called the Clear Path to Cash. And in the Clear Path to Cash, fuck, so weird. Thought I had it. Oh, there it is. The Clear Path to Cash is the same thing. I've got the demo company here. You can find hidden cash in your business with it. The Fast Money formula is what we just went over. And I do the Fast Money demo here, and it's the same thing. Inventory plus AR minus AP equals the financial gap. And there's your numbers in your calculations. But instead of just doing what if scenarios where I type numbers in, I've now got these sliders. And see how there's a shortage of 476? When I do the sliders, these numbers change, and it will tell you when, there it is. We'll say 60 days. If I move to 60 days, I no longer have a shortage. More importantly, it tells me what to look for in my balance sheet. So if you haven't used a balance sheet, like I don't know what these numbers mean, this means that every time my inventory gets over $962,000, I need to run it down because I'm getting my gap too long, right? So this tells you what to look for on the balance sheet to keep your money in your pocket and not in the vendor's pockets. So I am Cashflow Mike. You can reach me at mike@cashflowmike.com. Go get the free ebook. I'll collect all of the email addresses from Maureen and send you out, or she can send you out the inventory master worksheet and the Fast Money worksheet. I'll send that to her right after this, so you'll be able to get it. Kelly, thank you very much. I actually did a 2-day seminar in Bakersfield, I think for Rabobank. Are they there? Or is Tri-Counties Bank there?
They both are.
Okay. Well, one of those two brought me into Bakersfield. I'm going to say right pre-COVID. So BC, before COVID.
2019.
There you go.
Well, I wish I'd have known that. I would have had you stop by and say hi.
Absolutely. I will next time I'm in town.
Okay, great. Well, a lot of great information. I see we have a pretty shy audience today. No questions. We got to have some questions for Mike.
I probably went a little fast because it's numbers, it's math. I can tell a quick story if you got time. I can tell you a quick story about a product where this was a particular, and it was a company that was running good, right? So not every cash flow problem is a company that's struggling, that's bad. You could be successful and still run out of money. So in early 2000s, I had a friend. His name was Alden Mills, and Alden created a product called the Body Rev. I don't know if anybody ever heard of Body Rev, but the Body Rev had 2 handles on a gray bar, and he was a big fitness guy. He had just retired from the Navy. He was into all this fitness, and he believed in aerobic activity, and resistance was kind of the key, right? And a lot of movement. Well, he raised $1.2 million from the 3 Fs. You know what the 3 Fs are?
Friends, family, and fools.
There you go. And not fools because they're foolish. They're just, they believe in you and just do whatever for you, right? They believe in you. Mm-hmm. So he, in 1 year, burnt about 1.1 million. He's down to about $100,000. He was on the Home Shopping Network, QVC. He was on his own infomercial and maybe sold 3 units to 3 people at 3 a.m. Right? It was one of those things that just didn't sell. So he says, I'm going to pivot the company. If you've heard that term pivot, that means I still believe in something core, but I'm just going to reintroduce it to the market differently. So he takes the handles out of this bar and puts them on 2 discs. And these discs allowed your hands to turn like this when you did a push-up. So when you did a push-up, they turned. And he called it the perfect push-up. I don't know if you remember that or not. All right. But the perfect push-up sold like gangbusters. It was everywhere. Walmart, Target, Costco. First year they did $2 million in business. The second year they did $60 million in business, and he almost lost the company. Why? Because here's what happened. That dream of being in Costco and Target and Walmart turned into a nightmare, because he would get the order from Walmart, we'll say 100,000 units, they'd sell out in a week, but he had all the raw materials, he had distribution, he had salaries, he had rent, all of this stuff. And that happened week after week after week. More orders, now from Costco, now from Target. He had invoices going out. He was successful on paper, but it took about 120 days to get that first check. So he had all of this payroll, all of this rent, all of these material costs that he had to absorb up front, and he just ran out of money before he got that first check from the big retailer later on. So if he managed the gap, he would have understood that he couldn't keep taking on larger contracts because he didn't have enough money to do that. So that's just kind of a tale of woe that I think helps people understand this concept a little better.
Great. And we have some questions now.
Oh, great.
First one is, it's direction for a startup business. And let's focus this towards, say, a mom and pop restaurant. We have some really big challenges ahead in California. The legislature likes to work a lot, and they passed a law where the 60 largest franchises are going to have a $20 minimum wage, and I don't think have any idea on how that's going to affect mom and pop restaurants who are going to be losing their people to people that are going to pay them $20 a minimum wage. So I think we have so can you preface that towards, say, a mom and pop food business, and give them some direction on what a new startup should look at from a cash flow side of things?
Yeah. So I think first of all, I saw the thing about numbers being intimidating. Can I give a direction from startups? I mean, don't be intimidated by the numbers. They're just more zeros. The math is the same. The concepts are the same. It doesn't matter the size of the number. But I can see where you're like, oh, no, that's not me. But in a new startup, and I ran restaurants, and I've raised money with software companies. And what we used to do is look at 12 to 18 months, meaning how much money will it take to do the plan that I have, which means if I needed an engineer, when I had restaurants, if I needed 2 waitresses, if I needed 4 cooks, if I needed 2 bartenders, the cost of that person, first of all, if you have to add that into your plan, which is how much will it cost me to run them for 12 to 18 months? Because that's the point in time when the sales should catch up, right? Which means when you're planning for growth, when you're planning to add expense, have enough cash on hand to be able to cover those, or raise enough money to be able to cover somebody for 12 to 18 months while you're waiting for the sales to catch up. As you're starting the plan, you have to look for, are there inefficiencies? I mean, I just went through this exercise with a client of mine where we look at everything. I mean, we looked at where the advertising is spent, and we do a thing called return on advertising spend, but there's a ratio to calculate, is it worth it? And you make just some gut calls. He was paying $3,000 a year, which really can be a lot, but not a lot, just because he didn't want to close down an old CRM because he didn't know how to deal with losing his customer database that he didn't even use. He just didn't want to use it. He didn't want to lose the data. He didn't know how to export it and put it into something else. So these are things where maybe, not everybody knows everything, but maybe showing somebody else, maybe using the SBDC and letting somebody else take a look at it. There might be a cheaper way to do what you're doing so you can compete with the larger companies.
Fantastic. Okay. The next question is, can you access the spreadsheet information on your website?
I don't have it exposed. I think I'll just, it is in the Facebook group. So if you're not in Facebook, I understand that's bad. That's why I'm just going to send it. Matter of fact, I can probably put it, where's the easiest place to put it? I can put it in chat if you still got some time.
Well, one thing that we do is we will send out to everybody who attends and actually even signs up for this webinar. We will send them the resources, and we can send it in an email to all the participants, along with a recording of this, and then also information on all the resources that were mentioned in the webinar. Maureen usually will do that, usually 2 or 3 days after the webinar.
Okay, so what I'll do is I'll give you both spreadsheets, and you can include it in the email.
Great.
Yeah.
Just to follow on that question, what information do you have online, and is there anything that you'd like to talk about that would be in any of the online resources?
Yeah, I mean, the biggest thing that's online now, if you're looking for free, right? I do some paid programs as well, but if you're looking for free, this ebook is free, and I'll tell you, it manages or helps you manage the financial health of your company instantly. I've told people more about their business in 7 minutes than they knew, after running it for 20 years. One of the techniques I love in here is how to read a cash flow statement in 15 seconds or less, because believe it or not, the cash flow statement is the tattletale of your business. It tells everybody knows how to read it, where the money came from and where it went. Additionally, I have a podcast. It's Mike and Blaine. Blaine is is a partner. We used to be competitors. I built a product called CashFlowTool. That's the #1 cash forecasting software on QuickBooks, the ecosystem. He built a competing product called Dry Run, and we just liked each other so much that we started a podcast, and we're on like episode 118. It's just called Mike and Blaine. And we talk a lot about stories like this, like, the stories about the perfect push-up, about things that happen with our businesses. So free resource there. The Facebook group, a ton of stuff. I put it there for free as well. If you go to the services tab on my site, it shows you that I have a Clear Path to Cash. It's a self-study video course. It's probably 6 hours of video, 60 plus worksheets, spreadsheets, and about 8 hours of training with me. So we've got all of that stuff as well. Hey, thanks for letting me share that.
Great information. Well, Mike, obviously I didn't give you enough time.
Maybe I'm windy.
No, I think it's obviously I didn't give you enough time, but we'll be talking. I think, I just am the people that are on this webinar, most of them realize how much I profess to know that cash flow is such an important aspect of a business, and people really need to understand their cash flow. And, I'll tell them all day long, main reason businesses fail is because they run out of cash. Simple and to the point. So we got to prevent that, or at least delay it as long as we can.
You and I have the same mission. I want to eliminate cash flow as a reason business fail.
So we'll be talking. We need to do more, and maybe some of the other programs that you have and some of the other things. But thanks for coming on. It's great. I have to tell everybody the story, even though we're running a little bit late now, is Mike was at our national conference in Nashville this year, and was really wanted cash flow. I'm going to be there. But Mike was in the first breakout session in the largest room, and it was the first session of the first day of the conference at 8 o'clock in the morning. And of course, I had met colleagues for coffee, and I thought I knew my way around the place, and I showed up about 5 minutes late, and the door entrance was about 4 or 5 deep with my colleagues, and I couldn't even get in the door.
Yeah.
So I got to miss the entire thing. So then I scrambled back to look and go, well, maybe they're going to repeat his, and no. So that was that.
No. Well, and that was a good one, because we did the 7-minute conversation, and that's one of my most popular ones around the country. And it takes like an hour to 90 minutes, somewhere in there. I think they give me like 75 minutes. And yeah, we were lined up all around the inside of the room and deep in the hallway. So, and it allowed me to also do a 1-day seminar the day before. So I did a pre-conference workshop that I think was very well attended. So I'm really appreciative and really want to help the SBDC.
Well, thanks so much for joining us, and we'll talk again. And thanks for all you do in cash flow, and enjoy the nice winter in San Antonio.
All right, buddy. Thank you very much. We'll take care.
Take care, Mike. And that is going to wrap us up for webinar number 300, a momentous occasion. We will be back next week for webinar number 301. We will have a special guest, Eric Ryan of Ryan. It used to be Eric Ryan Consulting, then I think it's now Mission Met. Great tools for nonprofits and for nonprofits to help them strategize a little different than what we've done with the other 300. So looking forward to it. So for Mike Milan and Maureen Busher-Dang, I'm Kelly Bearden. Everybody have a great day. We'll be back next week. Take care, everybody.